In a year full of twists and turns in the stock market, will we have a Santa Claus rally? Our chief equity strategist and economist, John Blank, is here now with that answer. John, before a bit of a losing streak in the market last week, overall, traders have enjoyed a very solid stretch for stock returns since the U.S. midterm elections. So is it time for that Santa Claus rally?
Typically would be, Terry. We're talking on Thursday, December 15th, and it typically would be the next 2 weeks for the Santa Claus rally. I don't think we're going to have one this year because of the Fed funds rate hiking and the European ECB rate hiking and now the Bank of England rate hiking. There's just too much rate hiking going on for stocks. And my fair value at the end of the year is around 3,900. It's basically where we're trading right now.
So historically, December is a fairly good month for stocks, but with all the choppy back and forth action that not only started the month off, but continued through the month here up to now, the chances of stocks ending the year just range bound pretty good?
Pretty good, Terry. I'd pay 85% chance that we're somewhere between 38.50 and 40.50 at the end of the year.
There's been a lot of downbeat remarks coming from the so-called Wall Street leaders that inflation and recession concerns are going to push stocks lower in 2023 from where they're at right now. Is that what you see for the first half of the new year?
Mr. Market always surprises us, Terry. The basic point everyone's pointing out, which I do agree with, is that, when you start rate hiking in April of last year and do it as steeply as we have, fastest in the 40 years of Fed rate hiking, looking back, those lags effects on the economy hit, somewhere, 8 to 12 months out. And that's certainly true for the first part of the year. Question I have for a lot of people out there, though, is I don't necessarily think it'll be in the winter. It might start in the spring. And so the push lock slowers thing may be a little in advance of that. And the other thing I would point out to people is the quantitative easing and the sheer amount of liquidity out there continues to elevate stocks regardless of what the economy does.
What would have to happen for the market to actually stabilize next year?
We need to see the core PCE, personal consumption expenditure, which is the Fed's version of economy-wide inflation, get down below 4%. The reason is that right now they have a terminal Fed funds rate at 5 to 5.25, which is usually 1% above the core PCE. So if they're anticipating the core PCE to get to 4%, and if it needs to do that first off, but if it gets below 4% in the first half of the year, that would cause the market to stabilize because that would mean the Fed would actually lower its terminal Fed funds rate.
What do you see as a threat to stocks in the first half?
The total opposite. The core PCE comes at 4.5 to 5. It's actually at 5 right now. So the anticipated 1% decline in the core PCE, if it does not happen in the spring, that's the biggest threat.
There seems to be an interesting development going on, though, that we should probably talk about. Across the last month, stock market returns have been strongly positive for ETFs holding solely ex-US stocks. What's up with that?
A couple things. One is that, the Chinese authorities are stimulating, and that is putting a bottom in and a catalyst for Asian stocks and manufacturing stocks generally. And then the other thing is, frankly, the European growth in 2022 has been stronger than people thought, and they're getting through this period of the Ukraine-Russia war better than people thought. So I think those are the two things, and that draws money into both of those markets and away from the U.S.
And is this the case with global stock markets also?
Not necessarily. It could be. I think it might begin. I think the valuations are extremely low and very attractive. But again, it's the Fed money. As long as you're rate hiking, money gets sucked in towards those rates that are rising. So as long as the Fed keeps raising rates, it's going to be tough to call a final turn in those global stock markets.
Okay, major firms located in energy, infotech, and financial sectors made it to your highlight list recently, and among them are Halliburton, CoStar Group, and Interactive Brokers.
Right. Halliburton is the number one ranked stock with a B for growth. It's in the top 7% industry, which is oil and gas field services. Stocks, been over the last, 6 weeks staying around $36 a share. Forward PE is 17.7. I don't necessarily like this stock, given I think oil has done its run and people are selling out of it. But the fundamentals are still there for the earnings. CoStar Group number one ranked stock. This one trades at $80, and the forward PE is 65. Why is that? Well, it provides information services to the commercial real estate industry, and people like the kind of business here, and they really think the growth is there for this type of business. I'm not a buyer of a stock like this, but again, the earnings are really attractive. Interactive Brokers, a number 2 ranked stock with a B for growth. This is a very well-known financial firm with brokerage linkages, automated global electronic market maker and broker for 150 exchanges worldwide. If you like the idea that people are still trading and interacting with markets that get more volatile, you got to like this one. Again, I personally, would stay away from the stock because I think the stock market will go down, a transaction will go down with it. But again, through December of 2022, this stock has had positive estimate revisions.
Our chief equity strategist and economist, John Blank, on the markets with a bit of a look ahead to the new year. And on behalf of John and myself, here's wishing all of you the best of the holiday season, whatever it is you celebrate. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.